Hey everyone, welcome to Wealth Redefined. I'm your host, Michael Reynolds, certified financial planner, owner of Elevation Financial on the web at elevationfinancial.com. Thanks for joining me today, as always. We're going to go over some rules of thumb today to determine how much life insurance you need. So a quick statement on rules of thumb. I know there's a lot of chatter sometimes out there about how rules of thumb aren't useful. Everyone's situation is, unique and individual, which is true. But I often find that rules of thumb can be really useful for people who just want kind of a starting point, basic answer. Some people just want some kind of general guideline and answer. And that's where some rules of thumb kind of come into play and some just general basic starting points. So I do like going over some of these rules because they are good starting points for many people. So we're going to apply that today to life insurance. So life insurance, when it comes to kind of figuring out how much you need, it can be a little bit daunting. There's lots of ways to calculate it, lots of ways to kind of arrive at the destination, so to speak, of how much life insurance you need. And again, it can be frustrating to continuously hear things like, "Oh, it depends," when you're talking about life insurance and personal finance in general. So rules of thumb when it comes to life insurance or anything in finance do not take the place of personalized financial advice, but again, they can help point you in the right direction. So let's apply it to life insurance today. So, determining the right amount of life insurance is important for a few reasons. One, it provides financial protection. Its primary purpose is to provide protection to your dependents if you pass away unexpectedly. The right amount of life insurance can help you cover, daily expenses, mortgage payments, education for kids, other financial obligations that would be important to maintain and cover in the absence of your income if you were to pass. Also, determining the correct amount is important because you don't want to overinsure. Just as underinsurance can leave your dependents in a difficult situation, overinsurance means you're paying more than necessary in premiums. We'd like to avoid that. It can also be used in estate planning. It can cover estate taxes, settlement costs, can prevent your heirs from needing to, quickly liquidate assets to cover expenses. So life insurance can be useful in estate planning as well. And ultimately, it's about peace of mind. It's about knowing your family will be financially secure if you were to pass away. That peace of mind is super important for everybody involved. So determining the right amount of life insurance, can be easier than you might think. There's some general rules of thumb that can help. So let's start with a few. But before we do that, why is life insurance important? Let's dig a little bit deeper into why it's important. So it offers that financial protection. So if you were to pass away, let's say you are in a marriage or a committed partnership, and one of you is the income producer, that's you. The other maybe stays at home with the kids or has lower income. If your income disappears, then that causes real financial hardship for the surviving spouse and your family in general. So as a side note, according to Policy Genius, 40% of life insurance holders wish they had purchased their policies at a younger age. A lot of times people delay this. The older you get, the more expensive life insurance becomes. This is one of the most common life insurance mistakes, is to avoid purchasing life insurance not until it's too late necessarily, but until it becomes maybe prohibitively expensive, or maybe you have health conditions that make you even uninsurable. So, it's really important to avoid delaying and make sure you lock in life insurance coverage as early as possible to provide that protection for your family. So one rule of thumb is, have 10 to 15 times your annual income in life insurance coverage. That may not apply to everyone, but that's kind of a general starting point that can be useful. So we'll go into that and some other details as well. And quick note, in this discussion, we're assuming that life insurance means term life insurance. This is the type of life insurance that is generally most appropriate for most people. There's other types of insurance, whole life, cash value, universal, variable. We're not going to talk about those because they're typically not appropriate for most people. So we're talking term life insurance today. So you want to make sure that you evaluate your financial obligations and your goals. You want to start by considering your current income, any existing debt you might have. Take into account monthly expenses like mortgage or rent, utility bills, groceries. If you have any loans, you take that into consideration. Also think about long-term financial goals. So let's kind of go through these bit by bit here. So factors when calculating life insurance needs. These are some rules of thumb. First, income replacement. Rule of thumb number one we're going to talk about is income replacement. So one of the fundamental aspects of life insurance is income replacement. If you were to pass away, your dependents would lose your income. That creates, again, as we talked about before, financial strain. So how does income replacement work with life insurance? So one common scenario is that the life insurance benefit is a lump sum that the surviving spouse or partner can invest to generate an income that's equivalent to the income that was lost. So if you pass away, in theory, your spouse or partner would invest that lump sum and then live off of the income. So to calculate the income replacement amount, consider factors such as your current salary, potential future salary increases, expected rate of return, and the number of years before beneficiaries would need the income. I'm sorry, the number of years your beneficiaries would need the income. So this calculation comes with lots of unknowns, but in general, here's an example. Let's say your annual income is $100,000. Your income replacement needs would be 80% of that, so $80,000. So let's assume that in this scenario, the surviving spouse needs to replace 80% of the lost income. Maybe they would downsize lifestyle to kind of make it work. The expected rate of return in this scenario could be based on the 4% rule, which is in itself a rule of thumb and not to be taken as one size fits all. But the 4% rule says that, in theory, one logical scenario is living off 4% of a portfolio, and that is somewhat sustainable for a length of time. So the lump sum invested would generate income of $80,000 a year. So in order to do that, you would need a death benefit of $2 million. So that means your life insurance need in this scenario would be $2 million because that is investable to create, in theory, a possible income of approximately $80,000. So keep in mind, this rule of thumb may vary based on lots of different details of your personal circumstances. So again, that's where it becomes more personal finance. But also, this scenario also assumes the surviving spouse relies on the income indefinitely and has no other sources of income. So this may or may not be realistic. If other sources of income are available, maybe there's a survivor pension, maybe the surviving spouse gets a job and is employed and makes an income. Maybe there's other investments in the mix. So the amount of life insurance would be reduced or adjusted based on lots of other factors that may be at play. All right, next rule of thumb, debt coverage. Another factor to consider when you are figuring out life insurance needs is debt coverage. If you have outstanding debts, such as mortgage, car loans, credit card debt, it's really important to ensure your life insurance coverage is sufficient to pay off those debts. So you start by making a list of all your debts along with their outstanding balances, factor any interest that may accrue, and then by having life insurance coverage for those debts, you can provide for your loved ones the means to settle those debts and avoid additional burdens in an already emotional and challenging time, right? So note that you'll want to factor in rule of thumb into this equation as well. So income replacement is part of the equation when you're factoring in debt coverage. So if you plan enough to pay off all debts, then in theory, the surviving spouse would have a lower income need because those debt payments would disappear. So think of that as well. So rule of thumb number 3, education expenses. If you have children or plan to have children in the future, you really want to consider their education expenses when calculating those life insurance needs. Education costs can be a pretty big financial burden. It's expensive. And so ensuring your children have access to quality education is a priority for a lot of parents. So, research the average cost of education, take into account primary and secondary, potential college. Factoring in these costs, you can estimate the amount of life insurance coverage needed to cover your children's education expenses as well. Next rule of thumb, final expenses. So funeral and burial expenses can be quite a chunk, and failing to account for that can, leave your loved ones with an unexpected burden when it comes to burial expenses. So when calculating your life insurance needs, consider the costs associated with those final arrangements. Research average funeral and burial expenses in your area, factor in additional costs like memorial service or estate administration fees, and include that in your coverage. Next rule of thumb, future financial goals. So in addition to just kind of the immediate financial obligations, what financial goals do you and your partner or spouse have? If you were to pass, what goals are still applicable to your spouse or partner? Do they want to provide an inheritance for children or leave a charitable legacy? Those types of things are really important. Do you want to have lots of travel to be part of your life or part of, your spouse's life? And that's going to be important to them as well. So factor in those goals that you're working toward And those can be supported by your life insurance coverage. Next, consideration for dependents. We talked about education already, but consider other needs for dependents. Factors like age, health conditions, future financial needs. How long will those dependents need support? Dependents can be not just children; they can be aging parents. They can be others that are depending on your income. So, make sure you're factoring in future needs for those dependents as well. And then finally, you want to factor in your personal circumstances and risk tolerance. So it's important to consider your risk tolerance because everyone's situation is unique and what works for one person may not work for another. So, look at your factors like your age, health, lifestyle choices, do you have any existing policies? The risk tolerance, though, is just what's your appetite for risk? Some people would say, well, I want to be very conservative. I want lots of life insurance coverage to make sure that every scenario is covered. Very conservative approach. Others might say, there's lots of options for a surviving spouse if I were to pass. We're going to take a risk on lower coverage amount, knowing that there are, options if I were to pass. And so I don't recommend being super risky. I recommend a very conservative approach and making sure your surviving dependents are well covered by life insurance. But risk tolerance is a factor in personal finance. So you want to be sure you're factoring that in as well and honoring your family's risk tolerance. All right, so let's wrap up here with a few other things. How long should the term be? So, the term length for life insurance really varies depending on lots of factors specific to the individual, like financial situation, age, dependents, debts, goals. The most common term lengths are 10, 15, 20, 25, 30 years. Those are kind of common lengths of time for term life insurance. So let's talk financial situation. If you have a tight budget, you might opt for a shorter term length because the premiums would be lower. Maybe that is less coverage over the life of your policy because it's a shorter term, but in the short term, it gives you coverage while you're working on your financial situation. Age, if you're younger, you might choose a longer term length to lock in that lower premium rate. Conversely, if you're older, you might not need as long of a term because you're closer to retirement. Kids might be grown. Your mortgage might be paid off. You might be closer to self-insuring at that point. Dependents are also a factor. If you have young children, your term might want to last until they're out of college and financially independent. If you're married, you might want a term that covers until your spouse reaches retirement age or until maybe you reach that point of being self-insured. What are your debts? If you have a mortgage, you might want a term that lasts as long as the expected repayment time for those debts, like your mortgage payment. And also goals. What are your goals for the policy? Is final expense the primary goal? Is it inheritance? Is it, the term is going to depend on what your goals are. So it's really important to note that the right term length might change over time as your circumstances change as well. So you also want to review and update your coverage on a regular basis. So, once you have the initial coverage mapped out, make sure you regularly review, update your policy, reflect any changes, life events like marriage, birth of a child, significant increase in income. Those all might warrant adjustments to your coverage in life insurance. If you pay off debts or achieve certain financial goals or milestones, you might be able to reduce your coverage. So those milestones might call for an adjustment that could be beneficial and more efficient for you. One note that I like to tell a lot of people especially younger people, secure a policy earlier rather than later. As briefly mentioned before, life insurance gets more expensive as you get older. Additionally, many people develop health conditions later in life, and those can significantly affect the cost or even the eligibility for life insurance. So if life insurance is right for you, or you think it might be right for you in the future, get your policy as soon as possible to lock in your coverage and your rate. So let's say, for example, you're a 25-year-old single person. At that point, life insurance is not probably very important to you. You don't have any dependents. You're not married. You're basically no one is depending on you. Your income's probably in the lower end because you're just starting your career. So life insurance may be the furthest thing from your mind. But when you're young, your life insurance premiums are likely to be fairly low. You can probably lock in a lot of life insurance for a fairly low rate. So let's say fast forward 10 years, you're married, you have kids, you're making more money. At that point, life insurance becomes super important. But let's say at age 34, you develop some sort of chronic condition that's going to dramatically increase the cost of your premiums or might even make you uninsurable. If you were to lock in your policy at age 25 for, let's say, a very long, 30 or 40-year term, for example, you're going to be very happy you locked in that low-cost policy at that point. So keep that in mind. It's hard to think for the future sometimes because you're living in the now and the future seems so far away, but these are good considerations to think through. So just kind of wrapping up, make sure that, this doesn't have to be overwhelming. Determining the right amount of life insurance does not have to be overwhelming. It can be following a few basic rules of thumb can get you started. Consider your income, your debt obligations, future goals, personal circumstances, risk tolerance, factor all that in, and that will help you get to a starting point for the right amount of coverage for you and your dependents. So, and then don't forget to update and review your policy on a regular basis to make sure it stays current with your life situation. So again, I want to stress the importance of life insurance. So many people are underinsured. I see countless folks I work with or talk to all the time that just don't have adequate coverage. Unfortunately, I've seen tragic situations where people have died without the right amount of coverage in place. Their loved ones struggle financially, and it's an already emotional time. And financial struggles on top of that are just added burden. So get the right amount of life insurance. Reach out if you have questions. You can always find me on the web at elevationfinancial.com. All right. So with that, I already told you where to find me, but I'll tell you again, just in case, elevationfinancial.com. You can reach out, ask questions, or even better, book a complimentary money session if you'd like to ask questions about working with me or just general questions. Happy to give you feedback. All right. Thanks for joining me today. As always, appreciate you. Have a great day. See you next time.